It's the week before Christmas, but the financial markets have not taken their foot off the gas. Joel Kruger of FirstMacro is on the phone now for the final weekly wrap-up of 2013. Joel, obviously the big item for the week was that US announcement. However, in your view, what have been some of the other market-moving events of the week?
I think clearly a lot of the attention was on the FOMC decision and the impacts, but a couple of things that I would pay particular attention to are the emerging markets. And if you look specifically at some of the economies and currencies where foreign inflows that are dependent on foreign inflow for growth, you really saw some weakness that came through. And if you look at Brazil and Turkey and South Africa and India and Indonesia, countries like that, we really started to see some relative weakness there. And I think that we had seen a little bit of that this summer in response to the expectation of a taper, and seeing that again now, I think is sending some messages looking ahead that we could be in for some rocky waters as the markets start to price in an expected reversal in Fed policy.
In its last FOMC meeting of the year, the US Federal Reserve announced that it would commence tapering in January 2014, reducing its $85 billion asset purchase program by $10 billion, with a view to continue reductions should the US economy continue to improve. Can you walk us through market response? Not quite the taper tantrum many had anticipated and feared.
That's right. We really didn't see, but it really depends on what market that you're looking at. And I think that if you're looking at the fixed income market, and the commodity market and the currency market, we did see a bit of a reaction, as highlighted before. We did start to see a bit of a reaction in favor of the dollar and an expected yield differential in favor of the U.S. dollar as this market chose to focus on the taper and the fact that the Fed, this is probably the beginning of the end. Now, equity markets, like you said, there wasn't much of a taper tantrum, and I think that's because the equity market chose to focus on a different side of the rate decision and the overall tone, which was quite dovish despite the taper. So I think the equity markets were looking more at the forward guidance language, well beyond 6.5% and other things like Bernanke said in the Q&A that the Fed was not doing less, and that's sort of where they chose to focus. But in the end of the day, I think that the fixed income market and the commodity market, as reflected by the drop in gold, and the currency markets really are moving in a better direction in terms of responding to this taper.
It's been an eventful week, to say the least, for Europe. Firstly, with German ZEW smashing forecasts, hitting its highest level since April 2006. And today, the announcement that the EU has been stripped of its AAA rating by Standard & Poor's. How is this conflicting outlook likely to play out for the single currency?
So I think the conflicting outlook is quite appropriate at this point. I think we have to understand that when we look back at the context of the entire global downturn and the global crisis, we had a crisis that began in the U.S., then quickly spread to Europe and Eurozone, and then now is sort of it's spreading its wings into the emerging markets. So you're dealing with an economy in the Eurozone that's pretty much seen the worst and is on the path to recovery, but not quite there. So to get conflicting data and conflicting developments coming out is quite normal at this point. And specifically when we talk about the downgrade, I think it's not that big of a deal in the grand scheme. And also, the data out of Germany, while solid, there are still some rooms for concern in the broader Eurozone. We have to remember that Germany is the strongest economy, and we do want to see a stronger, more consistent recovery across the region.
And lastly, has this week seen signs of the infamous Christmas rally? Or could we still see elements of the December surge in next week's limited trading? Where is this likely to be felt?
So from my experience in the markets over the past several years, there has been a tendency for markets that have been trending to continue to push into the lighter, less liquid trade into the holiday trade. So markets like equities and the depreciation in the yen and the sell-off in gold, that likely could continue to push, despite the fact that these are markets that I believe that are extended to some extent, some more than others. I think that equities are more extended. But I do believe that we should expect to see a reversal in these markets into early 2014. However, towards the end of the year, it is possible that we do see an extension on the thin liquidity.
Thanks, Joel, for your comments. Well, viewers, that's all for now, but why not take a look at today's press review to find out why an injection of funds has not been enough to drag China out of its deepest cash crunch since June. For now, though, it's goodbye from me.